what's up, everyone? Welcome to day 34 of the Trading Academy. In today's video, we're going to be going over something super simple. It is going to be inverse fair value gaps. Now, inverse fair value gaps is pretty much just like a fair value gap, but you're just going to use it as an inverse, meaning when a body of a candle closes above or below a fair value gap, when it's being disrespected, you can use it as support for your draw on liquidity. So inverse fair value gap, super simple. So let's say here we have a fair value gap here on the 15-minute. You drag it out. You may expect some sort of reaction, right? Because you think that the draw on liquidity is down over here. But let me go ahead and open up the other charts, and let's go to these this price action here for this day. Let's see if we formed any sort of SMT. So we didn't. Okay, so we didn't form any sort of SMT. I just wanted to see if we did, to let you guys see that that's the reason why we didn't take this low. But there is another reason why we didn't take this low, which we'll be covering that in the following week. I'll actually come back to this exact example so that way you guys can see it. So remember this example here. Anyways, okay, so maybe you're thinking that, okay, we're looking for this low or something, and then, the day goes on, and then price comes up to this fair value gap, and we're obviously in a, we're in a premium, we're hitting the CISD, we're hitting the order block at around this fair value gap, we're in the premium fair value gap, etc. Remember what I said about fair value gaps, okay? This is going to go back to the basics of the fair value gap video. You want to look at that midpoint, right? We close a body above the midpoint, okay? So this is where you want to start being a little more cautious, because it's like, okay, now you want to wait till the next candle. You want to see what the next candle does just to be safe, okay? Just to be safe. If you were to get a reaction on this candle and it were going to the downside, you could always find an entry on the lower time frame. But since the 15-minute body, this one right here, closed above the midpoint of this bearish fair value gap in a premium, you want to wait. You want to wait and see to see what the next candle does. And as you guys can see, this pushes up, it closes above the fair value gap. Now this fair value gap is disrespected, okay? So this bearish fair value gap, you can use it as potentially support, right? You can use it as support for price to go higher. And now where would price go higher, right? Where is price going to go if it uses this fair value gap as support? It's going to go up to this high, right? Or actually, better yet, these relative equal highs right here, right? Because price looked like it wanted to reach up to there, but then it fell down early morning, and then it started reversing later in the lunch session. So we got up above this bearish fair value gap in this little external range right here. We closed a body above that fair value gap. We disrespected it. When we closed the body above it, we came back down into it. And look, we never closed a body below the inverse fair value gap's 50%, right? The midpoint, the consequent encouragement. We never closed the body below the 50%. We used it as support, and then we flew up to these relative equal highs, right? This buy side liquidity. Now, the way you want to use inverse fair value gaps, and to be fair, I don't really use them as much as I should be using them, but I wanted to throw this in the academy because it is a useful concept. I have a lot of friends who use inverse fair value gaps as like their main trading strategy, and it works really well for them, but they are sacrificing, so they have a very high win rate, but they're sacrificing, like, I guess, like, they take profits too quick. They have a high win rate, but a low RR, if that makes sense. Because they're constantly winning, but it's very low RR, right? Very low rewards, if that makes sense, right? They're hitting one to ones, 1 to 2s, which is still decent. I'm not gonna lie, it's not bad. So the way you would want to play an inverse fair value gap is right when the body candle closes above the fair value gap, or you can wait for it to tap back into at least the midpoint of the inverse fair value gap. So let's just say that we're looking for a trade here, and I see this body candle closure above this. You could go ahead and enter a trade there, and then you would place your stop below the candle, like this one right here. You could place a stop right there, or you can have a fixed stop. You can do 40 points, or this is a very wide stop, 60 points. You're also not sacrificing, but you also have to reduce your position sizing when doing stuff like this. And as you guys can see, this is about a 1-to-1. So you have a very high win rate. This concept has a very high win rate, but again, you are sacrificing more R's to collect, more rewards to collect, and you are sacrificing a higher position sizing with this concept, but it does have a high win rate, so that makes up for it. So when you close a body above it, you can definitely just market enter there, place your stop below this candle's low, or you can wait for, you can have a limit in the at least the 50% of the inverse fair value gap, because sometimes price will come back down and tap into that area, and it's even better if it doesn't close a body below the 50%. So you can definitely set like a limit or something like this, or just wait for this candle to close and then market, and you'd have your stop at the same spot. So this obviously looks way better, and you would just aim for, you know, the relative equal highs, right? So that is pretty much what an inverse fair value gap is. All you want to do is just wait for it to be disrespected, and then watch the fair value gap to see if it's being used for support. Let me see if I can find another example here really quick. Preferably a bearish one, right? I want to look for a bearish inverse fair value gap. So this is perfect actually right here. So we have this fair value gap, right? We've used it, and we've tapped into it a couple times already. We tapped into it to make a higher high. We came back, we tapped into again, we tapped into again. We refused to close a body below it. Remember, wicks through the damage, body still story. And this one, boom, we closed below it, right? We closed below the 50% level. So that's a very telltale sign that this fair value gap is probably not going to hold. The next candle opens lower. We come back up. We tap into this fair value gap. So you could use this as an inverse fair value gap, okay? So remember, when we close a body below the 50% of any fair value gap, whether it be a regular one, inverse one, that's going to be a telltale sign that, okay, maybe price is going to go lower. So you could aim for like this low right here, which obviously got hit super fast. And then you could aim for like this low, and then these relative equal lows down here. So where you would enter around here, like if you were to zoom into like the 5 minute, oh, I just lost my spot. If you were to zoom into the 5 minute, right, this is a 15-minute inverse fair value gap, okay? And actually, you could even see it even better. You can catch a better entry on the 5 minute, all right? So let's just forget about this 15-minute for a little bit, and let's come up to here. Let's come up to this 5 minute. So this 5 minute gets tapped into. We close the body below the 50% of this one, and as you guys can see, we close a candle below this one. So this is actually a way better example than that 15-minute one, but if you're looking at the 5 minute, this is actually a very good example, right? This is that last fair value gap before, you know, price got sent higher. So this is the last imbalance, came back down, closed the body below the 50% level, closed a full body below it. So here is when you can definitely enter a position. You can market enter here, and you would place your stop below or above this high right here, this last candle that disrespected that fair value gap. And then you would target, obviously, you know, I would target like the lows down here. And this actually runs really good. This is actually a 4.34 RR. So super, super nice, actually. And what's nice about this is that you never get bodies closing above the 50% level, which is very, very nice, right? It's being used as resistance now. This is true support and resistance when you use fair value gaps for inverses or even regular fair value gaps. But as you guys can see here, this concept works really, really well. Just, you know, when we close below a fair value gap, look at it, see if it's being used as an inversion, right? Not always will this work, but it does have a very high win rate, especially if you're scalping or if you're just taking 1-to-1s, 1-to-2s, etc. If you have like a fixed rule on these inverse fair value gaps, you can win a lot. Okay, and to be fair, like I said, I don't use them a lot like I should. I should be using them way more because it works really, really well, especially if you know the draw on liquidity. But yeah, hopefully you guys enjoyed this video. Hopefully you guys learned something here today. Inverse fair value gaps are a powerful tool, and I'm actually going to be, the next week, I'm actually going to be showing you guys a model just using the inverse fair value gaps. It's like the most simple model that a lot of my friends use, and it works really, really well for them. So I'm excited to share that with you guys. But yeah, this is going to be I think this is the last video for this week. If not, I think we'll be going over, I don't know. We'll see. But I appreciate everybody watching this video. Catch you guys in tomorrow's video. Peace out.